1/3 of mortgage applications were denied nationally. Okay, so if we look at that, then we say for every 2 houses that sell in your local market, a third house would sell if the person could get the financing. So that kind of gives us an idea of how large the buyer pool is for owner financing.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 201. My guest today is Brad Smotherman, and Brad owns and manages a 7-figure per year flipping business called American Community Investments, and he holds notes across Middle Tennessee. He's invested in 14 different states, and he's completed hundreds of transactions. Brad also hosts the business podcast called Investor Creator, and he's teaching real estate investing in a creative way. Brad, thanks so much for being on the show today.
Brian, I'm so excited to be here. Appreciate you having me on.
Why don't we start with you just telling us a little bit about yourself and how you got started investing in real estate?
Yeah, so I'm based out of Nashville, Tennessee. I'm a 33-year-old father of 2 and husband. I got involved in real estate investing about 10 years ago. So it was 2010 when I decided to retire my real estate license. So I got licensed in real estate when I was 18 years old. That was in 2005. And I sold real estate for about 5 years as I went through college. And what I realized during the crash is that I didn't want to just be a salesperson. I wanted to own something. I wanted to own real estate because what I saw in the crash is that the real estate agents that were doing super well during the boom of 05, 6, and 7 were going back into their offices and cold calling again to make ends meet. And there's nothing wrong with cold calling, but it's not what I want to do in my 60s. So I decided then that I wanted to own something. And so I found a mentor. And in 2010, I retired my license just to do investment. And we've been buying and selling houses ever since.
Why don't you take us through the first one that you did? Up to that point, had you done any sort of real estate investing?
No. So my wife and I had bought our first house to live in as an owner occupant. And I went to the bank and said, well, guys, I've made a few months payments. I'm going to be this big real estate investor guy, and I'd like another loan. And they looked at my credit history and they looked at my debt to income ratio and all the qualifying things that they do. And they said, well, Brad, we are 100% happy to give you another loan to buy investment property as soon as you pay this loan off that we just gave you. And so it really didn't do much for me. It's like I had no ability to get credit. And so it was kind of a tough time. So, we're doing very, very well now. But one thing that I'll tell the audience is that, things don't happen overnight very often. So people talk about the overnight success. Well, generally is 10 years in the making, and my story is really no different. But, my first transaction, I still remember the call, and I still remember how beat up that I felt because I'd talked to all of these sellers. And again, this is in 2010 because, the real estate market had completely crashed. Nobody had equity. Foreclosure rates are skyrocketing. And so it was a really, really difficult environment to buy equity. But luckily my mentor, he was able to teach me how to buy subject to and to create owner financing. And so I still remember the phone call, and the voicemail came in, and it just sounded like every other voicemail. Honestly, I didn't even want to return the phone call. And I really had like a devil on one shoulder, an angel on the other shoulder kind of moment. Like, are we going to return this call or not? It was like, well, Brad, you wanted this, so you have to go and return the call. And I bought the house. It was a divorce situation. To put numbers to the deal, I bought it for $97,000 subject to, and what that means is that the loan remained in my seller's name. They were fully aware of that. And then I turned around and I owner financed the house for $135,000 with $20,000 down. So I got $20,000 cash in that transaction to me. which felt like $20 million at the time because I had about $200 in the bank. Okay. And I got a note. So the note was to throw off monthly cash flow. And that's pretty similar to the kinds of deals that we do today.
You bought the property subject to, which basically means you just took over the mortgage payments for the current homeowner. Is that correct?
Correct. That's right.
But then you said you did another loan where you were able to put $20,000 in your pocket. Explain that. I'm a little unsure how that worked.
Yeah, and so here's kind of a little bit more specific on that transaction. So I got a contract to buy that property for $97,000 subject to, and my seller was getting $0 in walkaway money. So they were getting no cash at closing. They were going to be behind on payments. They just wanted this house done so that they could go and divorce each other. Okay. So I turned around and I marketed to find my buyer. And so I was marketing the house with $135,000 sales price. And that buyer came in with $20,000 down. Okay. So at the end of the deal, we all go to closing. I get $20,000 effectively as an assignment fee, and the note effectively as an assignment fee as well. So that was my first transaction. I guess it's a quasi flip assignment, but we were able to sell this house solely because we created the financing and offered the house with owner financing.
And what happened to the first note that you purchased subject to?
Well, it remained in place until that buyer paid it off. And so they did that a number of years later. So from the perspective of the seller, they were going to be in a situation where this note was going to default. So, they were on the mortgage, they were on the hook for that money, and they didn't want a foreclosure on their record. So the payment was continually made to that first lien position. I had a second that was on that property, and that was part of my profit to buy and sell that property.
Okay, so if I'm doing my math correctly, the ultimate buyer took over the payments on the first note. You put $20,000 in your pocket as a down payment, and then you created a second for probably somewhere between $10,000 to $15,000.
Yeah, it was $18,000 as a second. That's correct.
Okay, so is that what you call a wraparound mortgage?
That's right. So we do true wraps. We could just do a standard second mortgage, but anytime that there's an interest rate spread between the first and the second, then you want to create a wrap because it helps your cash flow.
And did you create an interest rate spread between what you were paying on the subject to mortgage and what the ultimate buyer was paying?
Yes, and that's a big profit motive for us. So I think that the first was somewhere around 5%, and I sold that loan at 7.9. So we were making 2.9% on top of the first, and then 7.9% on our second.
Wow, so you're using some pretty creative and sophisticated loan structures here.
Correct, but it was out of necessity. I couldn't go and borrow money, so we had to find a way to do transactions without needing cash and credit to do the deals. And so this is the way that we ended up doing it.
Mm-hmm. And two things there. You said you were looking to buy a property with equity. You were looking to purchase equity. Explain what you mean by that.
Yeah. So, of course, equity is the value minus the purchase price or the debt that's on the property if you already own it. So, we're not people that look for future appreciation. I'm not someone that looks for just cash flow, although I have some rentals. But my first prerequisite for me, if I'm going to buy a property, is I have to have equity. Okay. And we can do equity or create equity in one of two ways. The first way is price equity. So to put numbers to it, say a house is worth $200,000. If I can buy that property for $140,000, then I have a good enough equity position there that's fine. I'll pay $140,000 for it. I can also pay $200,000 for a $200,000 property. And I know what you're thinking. It's like, well, Brad, you said you needed equity. Well, if I'm buying with the right terms, then I have an equity position based in the terms. And so it's not a majority of our transaction, but a significant minority of our transactions we buy with 0% owner financing. So anytime we can do that from a financial perspective, the present value of those future payments is much less because there's no interest involved. Okay. So, I can pay $200,000 for a $200,000 property if the terms are correct. So that's, the prerequisite that we look for is we have to have an equity position in order to buy.
Okay, and just to be clear, when you say you're buying with 0% owner financing, the interest rate you're paying on the owner financing is 0%. So you're paying straight principal.
That's correct.
Wow. Okay. You also said that you had a mentor who was helping you on this early on, especially on the first deal. How important was that? Because, like I said, you're using very sophisticated and creative techniques there. It seems like for your first deal, you would need a lot of hand-holding.
And I absolutely did, and I find that most people do. No one is born a sophisticated real estate investor. It's not innate to know how to do this business, and there's a lot of emotions that are involved. Fear and having a lack mentality, which I certainly had at the time, and having a mentor was paramount. I never ever would have been able to do these transactions had I not had someone that had kind of walked that road to take me down that path.
Yeah, how did you find this mentor?
It's kind of funny back, and this is kind of aging me in terms of the real estate world. Back before Bigger Pockets, there was a forum called flippinghomes.com. And you had guys like Steve Cook and Sean McCluskey and a few other guys that were there. And I guess it was probably one of the top 3 or 4 real estate investing forums at the time. And so you had a group of people there. And so I posted a question about a deal I was trying to do. And this man named David Alexander responded. And he would say these cryptic things like never buy unless you sell and talk about notes and cash flow and all of this. And so I sent him a private message and asked him a question. And he responded. He sent me a cell phone number. He said, just call me. Now, I couldn't believe that because, he was on the RIA circuit at the time and all this. And so that's how we kind of struck up the relationship. And he's now a very, very good friend of mine. He was actually in Nashville at my office about a month and a half ago. And he's just turned into a great friend. Just really blessed to have him.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. He took on kind of that mentorship role and helped you walk through this process on your first deal then, huh?
Absolutely.
Were you able to duplicate that?
It's pretty much the same bread and butter transaction as what we do now. I do retail out of transactions where, we'll list it with a realtor and take the cash. And it really depends on various things in the transaction as to what we do in terms of the exit. But, we have in the next 24 hours, we'll buy 3, and two of those transactions will be transactions very similar to the one that I just outlined.
Now, the buying subject to, I can see how back during 2010, lenders would be more open to that because they'd much rather have someone take over the payments and have to foreclose on the property.
Sure.
But is it becoming harder to buy subject to? Or I know there's some people who say you just can't do it anymore. What's your experience with that?
Well, about 70% of our transactions are done with some form of owner financing, whether it's a subject to transaction or if it's true owner financing where the seller owns it free and clear. So about 70% of our transactions are done creatively on the purchase side. I don't find it difficult at all, and we're having a lot of success across the country buying subject to. The fact is that there's 2 different things that you need to create a subject to transaction. And the first one is a good marketing system that brings you motivated sellers, because if we have a motivated seller, then we can generally lead them down the path that we want because the house is the biggest problem in their life. The second thing that we need is a good negotiating platform that allows us to know what to say and how to say it so that we can explain things in a correct way, okay? But we're finding no problems in terms of being able to purchase subject to. I will say that up until this year, I'd never had a loan get called, and I've had 2 in the past year. Both of them were loans that I knew were a higher risk. One of them was a reverse mortgage, and one of them was with a local bank. And so one thing that I will say is you have to be a little bit more hesitant to do these if you are dealing with a local bank or reverse mortgage.
And when you say they were called, the bank or the reverse mortgage lender said, well, the person we made the loan to no longer is paying that loan, so we're going to call it in and it has to be paid off in full. Is that what happened?
That's correct. So that both of them wanted to be paid off, and that's what we did.
And did you have any negotiating power or any chance to discuss it with them?
We really didn't try. Well, I say that we didn't try once they called the loan. The one that was a local bank, it was kind of funny to me because I had spoken with the banker who was, and this is a small bank, mind you. So the vice president of the bank was also the special asset manager. And so I spoke with that lady and told her what we were doing, and she could not understand whatsoever what we were doing. And it was kind of funny to me. And I really think that she really didn't understand anything about notes or title. Okay. And so I actually have a voicemail from her saying, yes, I spoke to the president of the bank. I think we're all on the same page. We're going to service the loan, yada, yada, yada. And then it was roughly 60 days later, they send an acceleration notice to call the loan. And I'm thinking, do I really want to fight this? Like I probably could, but it's like, well, not worth it. Energy is something that I want to conserve, so we'll just pay it off, and that's what we did. And, both of those transactions were transactions that we were retailing out of, so it's not anything that we were going to keep in place long term anyway, so it really wasn't a big deal.
Yeah. Now, for those out there who are listening and saying, I'd like to do a subject to purchase, but I'm just so scared the bank's going to call in the loan and I'll have to come up with the money, what would you say to them?
Well, I think that people need to be self-aware of what their risk tolerance is. And so if someone is deathly afraid of subject to because of that, then I think that they should kind of go where their nature leads them. I look at it as the real estate equivalent of being struck by lightning. So we've done hundreds and hundreds of these. And in my career, I've had 2 get called, and both of which I knew on the front end had a higher likelihood that it could happen. And so it's not something that bothers me, but at the same token, I want to be able to have the ability to pay these off if I need to. So, and we have that ability. So as long as we have that ability, I feel very comfortable with it. But I would recommend that if someone is going to buy subject to, that they're, number one, you're 100% upfront and honest with your seller as to what's happening. And then secondly, if you're promising your seller that you'll pay it off if it gets called due, that you actually have the ability to do so. Because now I definitely don't want to put people in a bad position or tell people the wrong thing. And that's one thing that I'm kind of harpy on and probably too harpy, I guess. But, know yourself and what you want for your business. But if you're promising things, you need to be able to back it up.
Yeah. Now, you're full disclosure with the seller. What about with the lender? Are you letting them know, hey, I'm taking over this payment and you can start billing me now? I mean, what kind of conversation do you have with them?
Well, we certainly don't have a conversation. And I guess it's kind of an odd question. Do we let the bank know? One way that we can do these is to put them in trust. So a lot of people that do subject to, they put title in a land trust that is the seller's name. I don't do any of that. I mean, we take title to our LLC or whatever entity that we're going to be using. And it's constructive notice once title is recorded that there has been a transfer of title. And I guess that's obvious. But do we have a conversation with the bank and say, this is what we're doing? No, not really. We do send in a power of attorney. We do change the mailing address to our PO box. So, I mean, we change the insurance. So, I mean, they have some clues as to what's going on, but we don't have a formal conversation telling them what we're doing because, it's constructive notice when the deed's recorded that, hey, we've taken title.
So you just let the process inform them.
Correct.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. And how do you deal with the seller, the homeowner who took out that loan originally, who's now letting you take over payments? I mean, you must have to deal with their concern quite often that you don't screw up their credit or stop paying on the note, and then they have to pay, they're still liable for it later on down the road. How do you address that?
Well, and that's a great question, and it's something that as a buyer that's conscientious that we should bring up if they don't. So there are people that we deal with that are in significant dire straits. The three that we're looking at today, one just came out of a bankruptcy, and the other two have auction dates in terms of being sold at foreclosure sale. So these are people that worst case scenario is pretty much what they're living now. But it's one thing that we want to be upfront, and if the people don't ask these questions, we need to be upfront and ask them for them. And the two questions are, what happens if the buyer stops making payments? And how long is this loan going to remain in my name? Okay. And effectively on both of them, we disclaim. So I never guarantee that the payments are made. I actually tell them in our script work, Mr. Seller, you may have a situation in which I call you if I get 60 houses back in 1 month and say, hey, John, you're going to have to make a few months payments if you want to protect your credit. That could happen. Now, it's never happened in the past. I don't think it's going to happen, but it's like never say never. Okay. So within that script, we're actually disclaiming that we're not guaranteeing that the payments will always be made. Okay. And I think that that's just the most safe way to do things because, I'm healthy, I'm fit, I assume in great physical health, but God forbid I get cancer and I die. I want to be able to say that I didn't tell anybody a mistruth, right? The second one, how long is this loan going to remain in place? We disclaim it again and say, look, I don't have a crystal ball. Here's a range that we usually see, but we can't guarantee a date. Okay. And it's going to remain on the credit report and affect your credit history during that time. Okay. So we have to be upfront and honest with our people. And if your sellers aren't asking those two questions, I think it's a good idea to go ahead and ask them for them and then go that route to disclaim that there's situations in which the payments would not be made.
And then on the flip side of that, is it a plus to the seller that you are taking over their payments that will help their credit score stay high, and it will also prevent them from going into foreclosure too?
Oh, it absolutely is. It's a huge selling point. In fact, if someone is behind on payments, it's actually to their benefit that they sell with subject to financing because of that exact reason. So I've had it explained to me, and I'm not sure if this is 100% correct anymore because this was years ago, but I had a banker tell me that it looks much better to the credit reporting agencies if the payments are behind, that they're caught up and then made on time for a series of payments versus the payments are behind and then the loan is paid off. So I have to assume that that's still correct, but it's definitely to their advantage. It's a huge boost to credit from what I understand. Yeah,
great. And then let's talk about the wraparound part too. Is that still one of your tools that you're using?
Yeah, it's. I don't know exactly the numbers right now. I did calculate it earlier this year, and it was over half of our business was buying and then selling with financing.
And do me a favor and just explain that again. So because it's a two-part process that I'm finding really interesting here because I don't think we've talked about it on this show, but buying subject to and then putting another mortgage on top of that. Mm-hmm. Go over let's talk about the ins and outs of that second part, the wraparound.
Sure. So, once we have the ability to sell a house, then we're going to market the house to sell with owner financing. And I used to know the exact numbers month by month. I don't look at them month by month anymore, but I do know in January that 1/3 of mortgage applications were denied nationally. Okay, so if we look at that, then we say for every 2 houses that sell in your local market, a third house would sell if the person could get the financing. So that kind of gives us an idea of how large the buyer pool is for owner financing. And so the big picture of this is that I can sell a house with less headache. There's no appraisal. There's no home inspection generally. Although the buyer is welcome to get one, they usually choose not to. There's no home inspection. There's no repairs that have to be done. We sell the house as is. We sell it faster and for more money than I could by going retail. Okay, so we market the house. We have people in it. We do standard 30-year notes, generally at 7.9%. Sometimes we fix a rate, sometimes we don't, whether we want that note to cash out. But effectively, we're in the paper business. We're interested in owning mortgage notes. And so the houses are a means to an end to get to our final destination, which for me is interest income. So we're really interested in creating good assets. We provide home ownership. We have people that have a pride of ownership, and they have really good down payments. So, I mean, our average down payment is somewhere around $25,000, and we've had multiple down payments above 50 on a $150,000 or $200,000 house. So, from that perspective, it makes sense, in my opinion, to finance regardless of what the banks would do.
And you're doing this on top of subject to mortgages. So you're paying off that first loan, creating a second loan on top of that, which part of that payment is going toward paying the first loan. And then you're making money off the interest payments. What kind of spread are you usually seeing? What kind of returns do you get on that?
Well, it's kind of interesting. The last four that we have bought are somewhere around 3.5 to 3.75% on the first. And then whenever we sell with financing, we're selling at 7.9%. So effectively in those kinds of transactions, we're making more money in interest than the bank is on money we didn't even have to lend and we have no risk in. So I think it's a great model. It's certainly a profitable model, and a model that I'm kind of surprised is not at the forefront of real estate investing as much as wholesaling and some of these other things. But we do pretty well on the interest rate spread.
Why are you surprised about that? I mean, why do you think wholesaling and some of the other strategies are more popular and more common?
That's a great question. I'm not really sure. I think that people view wholesaling as being easy, and I'll say it's simple but not easy. The idea of getting a great deal under contract and just saying, waving the contract in the air to a bunch of rehabbers and saying, "Hey, fellas, ladies, come and get it." But the reality is a little bit different. And I have wholesaled property before, but it's been a vast minority of the transactions that we've done. The problem that I don't understand about wholesaling is this, that if a seller is willing to sell to you for 60 or 70 cents on the dollar, would they not finance you if you knew how to ask for it? And if they will finance you, and I think we could probably agree that if someone's motivated to sell at 60 cents on the dollar, that they will finance if the buyer knows how to ask for it, then the buyer's in a much better position in that they can now take the house retail in many situations or sell with owner financing, and they're getting a much larger share of the profit versus just wholesaling a transaction off.
So your problem with wholesaling is that you feel wholesalers are leaving money on the table.
They're losing more. They're leaving more money on the table than they're actually making, without a doubt.
What are some of your costs then? Because since you're holding the paper, your expense ratio must be pretty low. What do you typically have to spend money on in your business?
Well, the money is spent to start off in marketing. So if we want transactions, the easiest way to create deal flow is to market for those transactions. And once you have effective and efficient marketing that is proven over time, then it's really like buying dollars at a discount. So we know with our numbers that roughly $2,000 has to be spent in marketing for us to capture a $45,000 equity position. And so over time, if we want more deals, we can spend more on marketing. And if we want less deals, then we can pull it back. It's very much like turning on the water faucet or turning it off.
So your marketing is 3 to 4% of the acquisition price.
I haven't really ever looked at it that way. One thing that I'll say is that good marketing should, at a minimum, 15x. And I say that as a minimum because with anything, there's a learning curve, or anything worth doing, there's a learning curve. So if someone's getting into the business, they may not hit as high as we're hitting, which is roughly 20, 25x at times. And we've certainly had months that were much higher than that in terms of marketing costs to our equity grab. But, we didn't start off that way. So there's a learning curve. So I hate to say that everybody should 20x their money month one with marketing, because it's probably not going to happen exactly like that. But over time, it certainly should.
There's definitely a ramp up cost there. So that's interesting. And that's 20x or 15x related to the equity that you're purchasing.
Right. So if we spend $1,000 on marketing, then we should capture at a minimum, on average, $15,000 in equity.
Interesting. And what other costs do you have?
Well, I mean, I have an office, which is, I'd say, a somewhat mediocre office. I mean, it's not filled with trim and marble, but it gets the job done. And, I have some staff. So I have a project manager that manages the rehab side, and I have an acquisition manager that manages the acquisition, and we have a part-time disposition person that helps us sell properties, and some VAs that help with the marketing. But I mean, besides that, we're pretty lean.
And let's talk about your team then. How did you identify what positions you needed help with?
Well, it was kind of by happenstance. And this is kind of funny. I think I'm generally pretty good with people, but I had one seller that called me, and he said, I want $30,000 for this house. And it was in a prime part of Nashville at the time. And I knew that the dirt was worth more than that. And he said, look, it's a rental. I don't want you to go into the house. I want you to drive by it and tell me whether you'll give me $30,000 or not. And so I drove by it, and it looked pretty good. And so I said, well, let me meet you. And so, and this was roughly 5.5 years ago, I'd say. And so I met him at his house, and I don't know what it was, but this man just did not like me. And he was an older person, and I was raised by my grandparents. I generally connect very, very well with the World War II generation, but for some reason, this guy just wasn't having it. And so he looked at my paperwork, and most sellers that I've experienced, they don't look at the purchase and sale agreement very much. But this guy looked at it. He basically took out his magnifying glass and went word by word, and he said, son, I don't think we're going to be able to do business. Here's your contract back. And I'm thinking, this has never happened before. So I said, I'm sorry, I don't understand. Do you have some paperwork you'd like to use? Because I'm not married to this one. I mean, if you think something's unfair, we can mark it out. He said, nope, I'm going to have to ask you to leave. And so I left. And, tail between my legs, because that was a great deal. And so there's this guy that I knew at Starbucks. His name's Tony, and Tony's still with me today. But Tony had been a pastor for 25 years and had just retired, and he was kind of in the middle of not knowing what he was going to do next. And so I'd seen Tony and was trying to help him with his first deal that he was going to be buying subject to, actually. And I said, Tony, will you call this guy and just tell him that you talked to me and see if you can work it out? And long story short, they got along great, but they still didn't come to a deal. Okay. But I realized that he was better with people than I am. And so I said, hey, you're kind of in the middle of things. This is what I got going on. I was just starting to ramp up things to the position that we are now. And so it just worked out beautifully, and he's been with me ever since. So I would say it wasn't really super well thought out, the hire that I had. It just kind of happened, and for some reason I just happened to get the right people.
Yeah. Did you ever find out why that guy didn't like you?
I don't. The only thing that I can come up with is I just bought a BMW. It was new to me, but it was a used BMW, and we were expecting my first child. So it was an X3, and it was a few years old. I mean, I don't think it was anything to really write home about, but that's the only thing that I can think of is it had just been washed and it looked good. And here it comes down the driveway, and then this young kid pops out, and that's the only thing I can come up with. I mean, maybe I had a bad look on my face. Maybe I smelled bad. I don't know. But I don't think so. That's my best guess, man.
So does that mean you're not the one who's talking to the homeowners and actually verbalizing the deals? You have your partner do it?
Correct. So Tony, he gets the leads. They come in. He takes them. Most of our leads right now are from pay-per-click, so Google AdWords and those kinds of things. But so our lead flow is relatively low. So if we have 10 leads a day, it's a pretty busy day. But we're buying 1 in 12. So we're pretty efficient in terms of the marketing, in terms of the amount of call volume that we get to the amount of transactions that we have. So he takes the call. He can pretty well decide at this point whether it's worth looking at based on our script, which I call the triage call. And I liken the first call with our sellers to like a triage nurse at the emergency room. So the triage nurse is the person that says, oh, you have a fever, you're going to the waiting room, but you have blood coming from your neck, you're going to see a doctor right away. So I liken the first phone call to that. The seller has to give us some idea that they're willing to sell at a discount. And so if it looks like it's something that's workable, they get an appointment. And if it doesn't, then of course they don't. So he goes to the house, he puts it under contract. Then we send out a home inspector to measure the house and to give us a home inspection. We then go back and renegotiate if we have to. Sometimes we don't, sometimes we do. And at that point, we can make a good decision as to whether we can buy that property or not.
Give us an example of like a big win, one of your greatest hits.
A couple of them come to mind. I mean, I would say my best deal to date is still my first deal because it gave me the confidence to say I am an investor and I can do this business. One of my favorite deals, I had a lady call. This was probably my first cash deal that I had enough money to actually pay cash for the house. And before we get excited, it wasn't much money. So this lady calls, and I can tell she's older, and she says, I have two houses and I want $20,000. And I said, okay, so 40. And she said, no, two houses for 20. So they're 10 each. And I said, okay. And I could tell she was older. And so I said, so what's going on with the house? And she said, well, my husband and my two children have all died in the past 90 days. And this is where we all grew up. This is where I raised my family. And it's too tough for me to go back there. I just can't do it. And so I said, well, how about this? Do you have someone that can be your advocate? You don't know me, and I can tell that you're a little bit older. So, is there someone that you can have there to meet with us? And she said, I think I know just the person. And she kind of giggled, and I thought that was odd at the time, but I didn't think much about it. And so I drive up to the house at the time of the appointment. And there was this undercover police car in the front. And it was a really nice undercover car. And I thought, they're here to hammer me for my bandit signs. But I was like, well, I'm going to go ahead and go to the appointment. And so I'm walking up to the house, and this great big man with this huge cowboy hat comes out, and he greets me. He's a sheriff. He says, son, I'm Sheriff George. I'm the sheriff of this whole county. And I said, okay, well, great to meet you, Sheriff. And we got to talk, and ended up he knew my uncle, and he was a real Andy Griffith type, and I just enjoyed hanging out with him. He's a great guy. But after about 10 minutes, he said, Miss Jones, you're fine here. I'm going to go on back to work. And so long story short, we bought those houses, but I bought them for $7,000, so $3,500 a piece. There was mold in the house. There was a squatter on one of the porches. They were in bad condition. It's a bad section of town. But and this was in the depths of the recession. So this was probably 2010. This was probably beginning of 2011. And so I just didn't know the value, and so I had to be conservative. Well, long story short, I started marketing these houses with owner financing at $25,000 a piece. And the neighbor behind her saw my Craigslist ad and paid me cash $35,000. And so I paid $7,000. I sold it for $35,000. Ended up, I called her back and I gave her more money because I just felt like, I would have paid more money up front had I known I would sell them for $35,000 cash. And I kind of felt bad that she had a for sale by owner sign on her front yard for 3 years that the neighbor behind her never drove by to see.
That's a big one there. That's great. You said you had several. What's another home run that you made? We
bought a house last year from a lady that had squatters in it off and on for 3 years. People would break in the house. It was a beautiful house. It was 4,400 square feet, river home on 15 acres. And she owned it free and clear. There was no real financial motivation besides she needed the cash for her business, which she had just gotten a big contract from the government. And so we negotiated her from $300,000 down to $160,000. And we put a little bit of work in the house, but we sold it for, I believe, $325,000. And we probably could have gotten more money, but it was just a pretty good deal the way it was. I had another deal. We bought a lot. Well, it was a house and lot at the time, but we tore the house down and we bought it for $70,000. We sold it for $245,000 as is. That was a pretty good one. We bought I don't know how many from a foreclosure sale, stopping the foreclosure, sometimes hours before the foreclosure sale. So those are always fun. So, I mean, it's tough to say like which is my favorite deal. I mean, we have some that we've made more money on and some that are just more emotionally gratifying and everything in the middle.
Yeah. What about on the flip side of that? Have you lost money on any of these deals?
Yeah, I've had a few. So the first transaction that I ever lost money on was last year. And what happened, we bought it, and in the previous 3 MLS listings, it had listed for 2,800 square feet. When we went to sell it, the appraisal came back and showed it was 2,300 square feet. And so 500 square feet at like $125 a foot makes a difference in value. And so that's the exact reason why we have every house measured that we're going to take title to now. I had another one that was a land development deal, and it pretty much broke even, but the county, I got approved for 12 lots, and I named this subdivision after my little girl. Ended up the county decided that they didn't like the plan arbitrarily. There's no reason in the code, and wanted me to do 6 lots instead. So they cut me from 12 lots, which got approved at planning, to the county engineer said, oh, we're only going to do 6. And so I went to an attorney, the top real estate litigator in Tennessee, and he said, well, Brad, you'll win, but it'll take 3 years and $100,000. And I was just like, again, it's about energy. Like, I don't want to be involved in a lawsuit that costs that and ties up my project for that long, because I didn't know what the market's going to be in 3 years. And this is in an upper end price range in terms of lots. So that was a tough pill to swallow, but it showed me really that anytime I'm involved in with the government in terms of one person being able to control my product, I just don't want to do it.
Yeah, that's a tricky business to be in.
For sure,
yeah.
For sure.
Yeah. So what's the typical profit margin you like to make on these deals?
I don't look at it in terms of margin, and really you can't even look at it in terms of dollar figure, because so I bought a triplex for $80,000. No, it was $85,000 earlier this year. That was worth only about 120. So in terms of a margin, or in terms of a dollar figure, it really wasn't that great. But we bought it for $25,000 down and $500 per month at 0%. So the terms of the deal can create a situation in which there's very little dollar for dollar margin or percentage, but the equity is really in the terms of the transaction. So, I mean, I guess a short answer is it depends.
What would you say to our listeners who like what you're talking about if they wanted to do what you're doing?
Well, I think that it's a great model, and it's a model that I think anytime we can take one transaction and get paid on it almost indefinitely, because we're creating 30-year paper, and of course it will pay off generally before that 30 years is up. But we're creating interest income. And what I like about interest income versus rentals, and I have both, is that interest income is stated. So there's no vacancy or repair that comes off of that. I think it's a great strategy. I think that it takes some time to on-ramp to, because you have to have a good understanding of marketing. You have to have a good understanding of negotiation and also deal structure. But once you have those three, we can pretty much make something out of nothing.
And you teach this technique, don't you?
I do. So, what I do is a little bit different. I take on apprentices, and so I partner with people in local markets, which is why I've been able to do transactions in 17 states now. But I don't really like the guru people in general. I mean, there are some people that are really, really good at what they do, and they do this business day in and day out. And then you also have people that, in my opinion, kind of take advantage, and they charge $40,000 or $50,000 for training. I've talked to some of these people that have paid that, and they don't even understand what subject to is. And I don't understand how that happens. But I do train people, but it's really on a case-by-case basis.
And as we wrap it up here, Brad, what final thoughts would you have for our listeners?
Real estate is an amazing business. And if housing ceases to exist, I don't know what I'm going to do. But I think it's one of the few industries where the average common person has the ability to create wealth. And there's various reasons for that. But if someone is interested in the real estate business, I think it's a great thing to get into. And the thing that I see with most people is that you grow emotionally as the business grows. So, generally people that have an issue with lack or negativity, like I did whenever I first started, have a difficult time in the business. But as those things change, your business begins to flourish. So, in terms of advice, if someone's interested in the business, absolutely get educated, find a mentor, and then at that point, sky's the limit.
And how would people get a hold of you, and also tell us a little bit about your podcast?
Yeah, so for those that are inclined, you can reach out to me at brad@bradsmotherman.com. Also, I'm on Facebook for those that are on Facebook and want to add me as a friend. And I have my business podcast, Investor Creator, and we're generally a top 100 business podcast on iTunes. So happy to have you listen to me there.
And Investor Creator, is that on this topic that we've been discussing for the past 40 minutes?
Yeah, so I really look at my business as three different pillars that hold it up, and that's negotiation, deal structure, and marketing. So those are the three main things that we talk about we have guests on as well.
Fantastic. Well, Brad, it's been really interesting talking with you about subject to mortgages, buying a property subject to the existing mortgage, the wraparound concept, and just how you've structured your business and really found success in a niche that's out there for really a lot of investors. It's just for some reason it is kind of overlooked, and I don't know if that's because it seems more sophisticated, but it's definitely interesting, and I can see that you've had great success at it.
Well, I appreciate it. I've enjoyed this very much, and happy to do this anytime you like.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.